Hi, everyone. I'm Rick Bensignor. Today is Tuesday, February 16th, and welcome to this week's In the Know Trader Show. When we take a look at this week's agenda, we're actually going to start today's trader education portion by talking about, I was going to title it, What is an In the Know Trader? And then I realized it's really who is an In the Know Trader. So we're going to talk about that. In our markets overview section, we'll look at the US 10-year, we'll look at gold, which continues to slide, and we'll take a look at the emerging market biggest ETF, EEM, in order to get a view on something that's been skyrocketing and has made new all-time highs recently, and what that means for the rest of the markets. And then as far as sector analysis, a couple months ago, I think it was early December, we looked at financials, but I thought, let's take a look at regional banks, because as interest rates move up, that generally really helps the regional banks. Of course, it helps the money center banks, but the regional banks, the local banks need higher interest rates because they're generally not doing the entire part of the banking industry, and they're certainly not investment banks. Their source of revenue generally comes from loaning out money. So the more the yield curve has a positive slope to it, the better they do. And so I figured let's take a look at them. So we'll take a look at, as long as we have time, we'll do as many as the 10 biggest holdings in the KRE, which is the S&P Regional Bank ETF. So that's what we've got on tap for today's show. I want to remind you, that in order to reach me, my email address is Rick at In the Know Trader. And of course, we have two publications that we put out from In the Know Trader. We have our monthly 7-Eleven report that comes out the night that ends a month and gets you set for the new month by reallocating as many as 7 of the 11 S&P Spider Sector ETFs. In the 6 months, that we've been doing it, we've outperformed by 1.9%, which annualizes out to just shy of 4%, and that is a huge victory over the S&P, considering about 85% of all money managers who are tagged to the S&P as their benchmark fail to beat it. So we are on the positive side, and instead of simply buying spiders, this is a way to kind of learn and understand how to manage money, your own money. And we have a portfolio, again, of anywhere from 5 to 7 of the Spider ETFs. And then, of course, Wednesday nights, I publish the weekly tactical trader report that gives you a whole overview of the markets, always focuses at some point in that piece deeply into the S&P and what my thoughts are on the broad market. And then we'll give you a new ETF to trade each week. It follows up with all open recommendations of everything else that we still have until we close out a position. So let's talk about who's an In the Know trader. There's a reason I titled my the whole website and my whole individual investor side of my consulting firm, which I would assume 99% of you are individual investors, or possibly financial advisors, but you're not necessarily on the institutional side. And I chose In the Know Trader because I really thought about, in my desire to help the individual investor, you really want to be in the know of what's going on in the street, and you want to be on top of how to play this game. And there's lots of people out there who have market newsletters, who do weekly podcasts. Their background may or may not match their willingness to try to sell themselves as experts. But what I'll tell you, and I suspect most of you know who are listening to this, not only have I been on Wall Street for over 40 years, but it's been in a very significant type roles that I've had, and not in any way, look, financial advisors are important people in many people's lives. But a lot of them, when it comes down to it, are really just salespeople who are looking to make a living by raising assets, and then they simply just put you into the investment buckets that their firm says you should be in. And so even though they're in the industry, I don't consider them like real students of the markets and people who really care as compared to being salespeople and making money for themselves. Then you have, plenty of financial advisors who really do care and truly try to learn and improve and understand this from a bigger way than just that they're set up to do. Um, and of course, you have individual investors, which is the bulk of who I think my listenership in this type podcast is. And I'm going to go through here some things, and these are just bullet pointed, but I think they'll help you understand who and kind of what and how you need to prepare and be in order to be somebody who's in the know, who has an edge, who's not simply um, turning on CNBC or Bloomberg TV or Fox and saying, okay, I know a lot about the markets. So the very first thing is that you do your homework before you enter a trade. You don't just turn on um, TV, hear what they're listening, or sorry, listen to what they're talking about and say, okay, let's go trade that today. Take the time and the effort. If there's a name you're interested in, it'll be there tomorrow too. Um, there's always opportunity. Do your homework. Find out about the company, what space they're in, what sector of the market, and is it an important name or is it not an important name? Are the institutions involved in that name? Because if they are, the market may move very differently than you think it would, as compared to some smaller cap names that individual investors may have larger holdings in and a bigger proportion of total the total float. So do your homework. That means spending some time to analyze your charts and analyze whatever fundamental information you can get about the company, so that you're not simply trying to be a trader who knows nothing and says, well, oh, it bounced on the trend line, let's buy it. Could it work? Of course it could, because it's a flip of a coin if it's going to work anyway. But you want to try to make the odds go your way, and one of the best ways to do that is to actually do some research on the company that you're looking to trade. Secondly, get yourself mentally prepared to trade. And you ask any trader, it is a taxing thing on the brain to be a trader. You tend to be shorter term focused. Um, if you're a trader who's a swing trader or shorter time frame than swing trade, and I usually think of swing trading as a few weeks trying to catch a little intermediate move, but you're not in that for the long term. You're not buying a name that you intend to hold. It's not an investment, it's a trade. So you can day trade, which is a very difficult thing for most people to successfully do. Over time, you may have a hot streak over a short period of time, but day trading is a very difficult thing to do, and I don't recommend it for most people. And then you have swing trading, which is a few weeks, and some people even could make that into a couple months, but that's kind of the limit of what trading is. Beyond that, then you're really investing. So being mentally prepared for the rigor of it, which also means getting good sleep, not stumbling into your in front of your computer because you were out partying the night before, or just didn't get enough sleep. You got to be sharp when you're trading. You really have to be focused. Again, it's a taxing thing to do, especially if you're looking to make significant money. So if you have a paycheck and you're doing this for fun, that's one thing. If you're trying to make your living from trading, well, then you have to treat it like a full-time job, and you wouldn't stagger into your office, with a hangover, maybe more than once a year or sometime where, okay, it happens to anybody, but um, you really want to be well rested and you want to be mentally prepared so mentally fit for the challenges of being a trader. That helps you be a better in the know trader because you're focused. Your trading parameters, and this bullet point itself kind of has wide parameters in itself, in the sense that again, how you're approaching a trade, what you're doing, your time frame. Are you getting into something that looks like in 2 or 3 days it could make a large move and you're in and out then? Or is this something that perhaps you're thinking about it being for weeks on end? So know your time frames. Also, when you talk about your trading parameters, know um, that if you get into, and we'll touch upon this a little bit more in some other bullet points, but your trading parameters also include knowing where your targets are for exit and knowing where your stop out is for exit. And both are equally important, and both you should know before you enter the buy or sell order. You need to know where your targets are, especially if you're short-term trading, and you certainly have to have your stop out level. If you don't put a stop in, then you're really setting yourself up for potential losses that go way beyond what you would have ever risked. You have to have stops. And if you listen to somebody else who says don't put in stops, I personally would take my 40 years of experience of having been a day trader all the way out to an investor. And when I talk about day trading, I traded in the commodity pits for 12 years right out of college. It's the first part of the street that my knowledge came from was actually trading on the floor of the exchange in the commodity pits. So, sometimes I trade a couple hundred times a day. So I know what day trading is to the nth degree. Um, Trading off the floor and day trading is a whole different challenge, especially with the amount of algorithmic trading and computer trading that's being done these days. Markets make huge swings for no reasons at all, and has nothing to do with, you could have done all the homework you want, but intraday you simply can't figure out why markets move the way they do. Watch what the S&Ps do on any given day, and that thing can move 20 points in 2 minutes on a buy program that came in, and you have no idea, and it slaps you in the face. So you've got to know kind of all in the sense of what you're trading, how it moves. Don't go start trading cotton futures if you haven't watched cotton futures for a while before you start trading them. And that would be the same about a stock. I would kind of watch the habits of how stock trades before I go start trading it. So if there's a new hot name on the street, and I forget GameStop or something like that, but let's just say there's a stock on the move and it's frequently being talked about, I would kind of watch it for a few days, watch the intraday moves, see how it moves relative to the S&P. Is it moving similarly? If the S&P rallied 10 points, did this move up or not? And how much did it move up? Did it move in sync or not? Things like that. That's all part of understanding the trading parameters of what you're doing. Next, execute your trades without emotion, whether it's a buy to get into something, whether it's a buy to get out of a short, vice versa. If you're selling, just, where your orders are supposed to be, put them in, take the emotion out of it. And it's easier said than done, but the more you can just put a trade on without the emotions, the better. I'll give you an example. Today I was trying to sell S&P futures. Have had limit orders in for a while, and I was trying to sell 39.60s. I've had an open order to sell them for a week there. Today's high is 39.59 and a quarter. Missed it by less than 1 point, selling the high of the day. That's where my resting order is. So I come in, I see that the S&Ps were off that level, and then they started selling off, and I end up putting an order in to sell them. They sold down, they bounced. I put an order to sell them in at 39.46. They got to 39.45 and then took another dive down. I go, darn, that's the second time today I've missed getting in by less than a point, or a point or less. And it just, they sell off again, and I put in an order to sell them at I think it was 39.33 after they had gotten down to 27. So sell a small bounce, but I kind of get the feeling today is going to be a down day, and that the early gains can go down and turn out being a day that loses and ends up down on the day. So as soon as I sell the 30, actually there were 32s, and I think about it, 39.32. As soon as I sell them, it's trading like 39.35. 3 points, no big deal against me. But they didn't even tick my way, one tick. They just went right up from 27 up to 35. But as I'm recording, and it's now about noon New York time on Tuesday, they're trading 39.24. And so, I've got a profit. The S&P's down 7 points. And I did it without emotion. I just said, my intention here is to play today on the short side. I missed it twice by less than a point. Darn. And that's it. That's the extent of my emotion, because I'm still trying to trade. I got to be focused on what I'm doing and what the market's doing. And, it's like, yeah, it stinks that I missed by less than a point. But if I'm going to trade and put my orders in, just do them based upon my analysis of what I think is coming next, and try to do it without emotion, which also means you want to stick to your predetermined game plan. I had a game plan for today, which was to be negative on the market, and that's the way I'm playing it. So I'm not going to try to pick some intraday bottom to get long, because that's not what my game plan is. Today, it simply was about trying to be short and find places to sell the market. Now, that's a daily predetermined game plan, because that happens to be what I'm personally doing today. But that would be, if I have whatever my game plan is before I get into the trade, that's what I should be sticking to, and not letting other things influence me. Especially, let's say somebody on one of these, TV shows, again, whether it's CNBC or, and somebody's talking positively about, let's say, the same stock I want to be negative about. Well, that's not likely going to change my mind. And I'm trying not to let that emotion come in that, oh, wait a minute, am I doing something wrong? Why are they bullish on something I'm bearish? I assume that if I'm putting orders in, it's because I've done my homework already. So I stick with my game plan. And look, the game plan could be wrong. But if I know what I want to do, then that's the way I'm going to keep myself leaning. Take profits at set targets. If you're short-term trading, the whole idea is to buy or sell something, and for it to move to where you thought it would move to, and that movement should be at a place that you have your target. So if you're long and you say, I'm buying a stock at 20 and you think it's going to 22 and a half, then put your orders in at 22 and a quarter, scale up to 22 and a half or 22.75, so that if the stock gets there, you take your profits, and that's your trade. So take profits at your set targets. If you only use mental targets, oh, I think you can go 22 and a half. Then when it gets to 22 and a half, you go, oh, maybe you can go to 23. And you try to eke out those last, 50 cents. It easily can cost you $1.50, because it gets to, let's say, 22.62, and then boom, it's gone. It's back under 22, and you go, when you miss it. And then you generally hold on and hold on and hold on. And that's just, if you're trading, that's not the way to approach. Set your targets where you want to cover a short or where you want to get out of a long. And the flip side of that is take your losses at your set stop levels. Don't play the mental stop game. Put your orders in. And if you get stopped out, you get stopped out. And that's it. You move on to the next trade. That's just the way it is. Because if you use mental stops instead of actually putting your stop orders in where you've determined that, if a stock breaks under a certain level that I've bought, then I'm probably wrong to have bought it. I want to get out. Take your losses, because otherwise you play this game in your head and your losses usually double or triple. And I can tell you that every trader will tell you that who's been around the block. So when people say, oh, don't set your stops, the machines are going to get them, everybody knows where they are, forget that. You're trying to control your losses. If the market goes to where you say, I should not be long the stock anymore, get out. And that should be something that you put your stops in. The moment you buy something, you should have your sell stop in place, and at least 50% of where you, let's put this right away, you should have no less than taking profit on at least 50% of the trade when you hit your profit target, so that you don't play the mental game and then give back. And usually, I personally take everything. If I hit my target, I get out. Enjoys the win, but doesn't focus on it. It's great when you get, you make money on a trade, you feel good. Of course it feels good, and you can enjoy it, but enjoy it for a few seconds or a minute or two, no longer than that, because there's always another trade to do next. And the next one you certainly might not win on. So enjoy the win. It feels good to have made money and gotten that idea correct, but don't get, focused on it. Don't boast to your friends and just go, oh, well, the greatest trader there ever was. No, just enjoy it, move on. And that seems the same for the loss. Take your loss and quickly move on. If you have placed your stops in the right place and you're good with money management skills, then it's just another trade. And so you weren't right. You have to be able to admit to yourself constantly when you're a trader that you simply weren't right, because you're going to take lots of losses. The goal is to make the losses small, and on the winning side is to have, the right targets so that you can win. And if you want, once you take at least half off at a target, move up your sell stop, certainly to break even, if not even. Look, if you made, I'll make up the thing here. You buy a stock at 20, it goes to 23. You take half off at 23 because that was your target. You certainly have to move your sell stop at least up to 20 so you don't lose any money on the balance. But I would probably move it up even higher than that, because I wouldn't want to give back more than, let's say, 50% of my profit. So maybe at 21 and a half, I put the rest, because if it gives back half, then maybe I just get out of the rest. But if you had taken everything at 23 when you first had it, then you wouldn't even have to worry about it, and you just move on to the next trade. And it doesn't matter if that stock moves up to 25 or not, and you could have made $2 more. So you could trail your stops, but you could also just say, hey, winning trade, move on. There's 8,000 stocks to trade in the US that don't even include the ETF market. You certainly can find something else to trade. And no, there's always another day and another trade. Don't get stuck on one day, one trade. It's tomorrow. Market's open tomorrow. If it's a weekend, it'll be open Monday. It's always another day. And you have to remember that. So no matter how bad your day was on any given day, there's always tomorrow. All right. So that's a little bit of the characteristics of somebody who's an in-the-know trader. And I think that it's a good way about thinking about things and how you approach the market, and why it's important to be an in-the-know trader, because otherwise you're really a sitting duck for all the other people on the street who are more prepared than you are, and chances are, you tend to lose over time, and that is not the goal. All right, let's get to some charts. Let's see, that's EEM. Okay, so we'll do it out of order because I just happen to have it here. So here's the EEM. Again, this has made all-time highs. If I correct here, that, let me just make sure there wasn't. Yeah. So we just eked out all-time highs. There we go. So we have just, here we go. We've just pushed to all-time highs. So of course the press is over this. Everybody loves this. I'm not convinced that this is necessary. I think, look, it's a good, strong chart, but just because we made all-time highs doesn't mean that it's necessarily going to keep going. And just like the whole broad market, it's certainly ripe for a possible pullback. And this has a lot of people long it, especially on the breakout move last week. So just realize that this is as vulnerable as anything else. If the dollar rallies, it's going to hurt the emerging market space. And the dollar is a big part of how this moves. So you've got to, be kind of focused on that. But obviously, good, strong chart. If you pull back to near 53 here from the current almost 58, that at least gives you a place to buy. Notice it has basically climbed up the conversion line, which is this magenta colored line of the cloud chart. So that's kind of first level support. Then second level, 52.80ish, and then down here at 50 or so. So if you want to get in, you might definitely get not definitely, you might very well get a pullback here. That's unexpected by a lot of people. Let's take a look, and I know we've talked about the 10-year. So here's the US 10-year on a weekly chart. So we gapped up this week. We're up in here actually. Daily chart, may be able to see this a little better. So let me quickly flip. So yeah, here's the daily chart. So look, we had rallied to what had been the highs of the move. Pullback didn't even play with the gap. We came right to it, and it still leaves this gap from 1% to about 96 basis points unfilled, and that's a big one. And we're heading higher. This zone in here from about 135 to 145 really represents close to what had been the all-time lows in the past. So we are testing those. I have been bullish. The yield chart, I think we're going well higher this year, still well above where we are now. If we ever pull back to that gap, I probably would be a buyer there and it would take advantage of, at some point a pullback into that. Don't know if we're going to do it, but I think rates move higher. We are overweight financials, and I continue to think that the bond market is kind of done with, and I've told anybody who's asked me recently, how much would I allocate to bonds, and I've said, actually, if you're in your 30s or 20s or 30s or even 40s, not a heck of a lot. I just don't. I think you're going to end up with capital losses on the bonds. As rates go up and prices go down, and I think that's basically what you're going to see. So I'm just not a big fan after a 40-year bull market in bonds from 1980 to 2020. I really think that not the place I want to have much money at all. TNX, what do we say? EEM. Oh, quickly, gold. So gold continues to be a source of funds. We'll look at GLD, a source of funds for other precious metals. And if I were, on the future side, this is the GLD ETF, which continues to trade in this downward channel since peaking in August last summer. We're still slightly above those June lows. To me, as long as kind of the bottom of the weekly cloud holds, we're okay. And that's at 165 or so. If it comes out beneath that, that's going to be a problem. Even though we're still towards the bottom part of the channel, gold has been above its cloud since it broke out a couple of summers ago of a 7-year sideways pattern, and you'd really want to see gold holding here. So I understand the weakness in gold. Silver, platinum are just better precious metals to be in, and gold is the place people are taking money out of. If you looked at open interest on the S&Ps, on the gold market, you would see that open interest continues to decline, which means there's less and less longs and shorts. In other words, people are just not interested in being in gold. They've closed out their positions. And because of that, you're seeing probably the same type allocation into precious metals just being done in other markets. And I see we're down to less than a minute. So next week we'll cover the regional banks. But let me show you, for instance, so this is the GLD, which obviously is similar to gold. So if I were to look at, let's say, silver, SLV, you'll see that this is that downward channel this came out of a couple months ago, back to November, and has actually been pushing higher. Now, of course, we're seeing multiple weekly 13s in here, which suggests that there's some exhaustion to the trend, and it's against the highs that we saw back in July. So possible double top near term, but you can tell just looking at this chart, silver is much stronger. And if we look at something like PPLT, which is the platinum ETF, look at this, and that's just been rocking to the upside. So even though it's got a 13 here too, what a difference if you were in platinum versus gold. Anyway, we're done for this week. I appreciate your listening. This is Rick Bensignor, and this has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.